Okay, good afternoon. If you can hear me, this is Neil with Simpler Trading, and we are both live over YouTube on this recast software, as well as in the Simpler Trading's Essentials room, which if you're joining us on the YouTube channel, please know that you can join us at simplertrading.com, and you're welcome to sit in the Essentials room and hear from a number of our different trade room moderators, content providers on some different trading strategies that we do employ um, in trading the various markets. And a lot of us trade different styles. Some trade options, some equities, and some futures, some combination thereof. But today we were asked, Simpler was asked by a room member and or guest to cover a topic, and that topic was trading with tick charts. And I volunteered because it's something that I do actually do a fair amount of and kind of advocate for. So to get started, I want to define what a tick chart is so that everybody understands what we're talking about. I'm not talking about looking at the NYSE's advanced decline up down tick, i.e. the indicator called the tick, which we use as like an oscillator or rev limiter that often just kind of oscillates between plus and minus like 500-600 valuations throughout the day. I'm talking about a candle, a price bar, a candle that forms with a buy or a sell that comes across the tape that forces price to tick either up or down. And with that transaction, that would form what we call a tick. And what we will do with that is take and choose and decide for ourselves what interval, i.e. the number of ticks that we wish to see formed on an up or down tick, which is a buy or sell coming across the tape. But by the way, that could be one contract or one share of stock or one whatever, or it could be 100 contracts. It's not an indication of volume necessarily. What it is an indication of the speed and frequency with which the transactions are coming across the tape, causing price to tick up or down, constituting one tick. And then we decide, as I've said, what interval or number of ticks that we wish to see in order to form one candle. So what you see on screen is something that I used a month of Sundays ago in trading some years ago. And from left to right, this is an S&P futures chart, but from left to right, you'll see a 144 tick on the left, a 576 in the middle, and a 2304 on the right. Why in the world those numbers? Well, 144, of course, is a fib number, and it's a place to start. It's an extremely fast chart, in my opinion, for an S&P futures contract. You would have to be very nimble, agile, quick, and alert in order to try to trade a frequency of that speed, a chart of that speed. This is my opinion. My opinion, though, is that everyone should take a minute to kind of, if you're going to populate and look at a tick chart in your trading and charting decisions, you should take the time. This is my opinion, but a firm one. You should take the time to play with some different tick intervals and get a feel for what the chart kind of matches your personality, your level of interest and alertness, I guess, and speed, right? So some are going to be comfortable with a faster chart and others not so much. They want more time for an idea to develop. And so they're going to use a much slower chart, right? It's just the way we all are. But the reason that I have these numbers on this chart, which I, by the way, I no longer use, I'm just making a point at this time. I'm just making a point. The 144 on the left is a fib number, a popular one that everybody knows. And if you increase in intervals of times 4, 144 times 4 is 576, times 4 is 2304. So that's the way that I originally had this chart set up some time ago, some years ago, actually. Right. But we develop as traders. We change over time. The level of interest that we have in like a move, like you start out wanting a couple of ticks or a couple of points, you change over time to, you scale in over a series of a couple of points to looking for bigger moves, or, your whole process changes, and mine has, right? But let me give you an idea of what you're looking at. So a 144 tick is, what is it? I mean, it's just 144 ticks. I've already discussed like what a tick is, right? But how long does it take for that chart to form? Essentially one candle or 144 ticks. Well, times 4 is 576, times 4 again is 2304. So what I did was I hired a programmer to write an indicator for me for TradeStation that would essentially time the formation of a tick candle. Okay. So across a subgraph on the bottom, I would get a color code, a series of dots, a color coded. So if a candle formed in 0 to 30 seconds, I would get one candle. If it was 30 to 60 seconds, I would get another color. And if it was, 60 to 90 or whatever, 60 to maybe 120 seconds, I would get another color. So what I found over time in average, middle of the day, average harmonic kind of regular price action, not news related like quick prints or hitting the tape, but just regular price action, that 2304 tick chart as a reference for you for the S&Ps took an average of 3 to 5 minutes to form. So it was like looking at a blend. So this is an opportunity now for me in my discovery. This is an opportunity for me to look at a tick chart, and in normal price patterns throughout the day and just normal trading activity, it also, I discovered, was a chance for me to look at a blend of a 3 and a 5 minute chart, but doing so and looking at a tick chart. So why would somebody be interested in looking at a tick chart? My answer, because there are many different types of charts and candles that you can look at. There are some that are range oriented that will go print a range like point and figure and Rinkos. And then after that range is printed, switch to the next candle because that range was fulfilled, right? If you got a 2x4 tick Rinko, then that's the range, and it's going to print to the next candle. So that's one way for people to look at a chart and see how much trading activity is visible on one chart. Therefore, you could get a sense of how active was that chart by answering the question, how much of a day or maybe a full day can you get on a chart in one picture if you're using a range-based chart candle like a Renko chart, as this is an example. Well, but that's not the question. The question that we were asked today was to cover tick charts. And I used tick charts, so I volunteered and said, I'll do that. I'll do that subject because I like these tick charts. My answer for and why I believe in the information that you can get from a tick chart is, one, you got to know what on average that tick chart is showing you. Like I just told you about the 2304 and how we got to 2304. And essentially on average, what that 2304 tick chart represents for that S&P contract, for that S&P futures contract. It's not going to be the same for crude oil or for NASDAQ or for gold or something like that, those things you have to go and discover and figure out for yourself. But what I feel like you get from a tick chart is the answer to velocity and momentum. Inside, you get a picture, you get a view, a picture of what does the velocity and the momentum inside of a 3 or a 5 or a 15-minute candle. What does it look like? Because if you populate simply a 15-minute chart, you just get an open, high, low, and close in 15 minutes. 15 minutes, it may have traded 5 wide or 15 wide. Don't know, but after 15 minutes, it's going to close and open a new candle. Doesn't matter the range, doesn't matter the momentum, the velocity, or anything. 15 minutes pass, you get a new candle. Not the case with a tick chart. You may get 1 minute pass, you may get 5 or 8 minutes pass. It takes that long, however long, to form that many ticks. Question: what's the speed of the transaction, the velocity and the momentum and the speed of the transactions across the tape in order to form a tick? How many ticks to form a candle? How long does that take to form? I believe you get the answer for a lot of that, most all of that, simply by one, knowing on average, what you're looking at in a tick chart, and then two, looking at the tick chart to be able to see the internal makeup of what a time chart on periodicity, like 5 or 15 minutes or something, is showing. So I no longer use this 144, 576, 2304 layout. I did. I like it. If you want to start with that, it's certainly a place that I think you can start. I use the 2304 as the anchor when I did use this chart layout. I'll show you my new one in a minute, but when I did, I used this 2304 as the anchor or for direction. The the 576 to kind of hone in on, within reason, like you could almost do without the 144, frankly. But with the 576, you get an idea of, entry. Like on this chart, this would suggest a short in and about the 24 area in the spoos up here. To further kind of dial in on that, you'd print that down to possibly, maybe 23. And then knowing that, then you switch over to your 144 and you wait for it to make the turn. And that's your actual execution chart. That was the way that I utilized this layout when I used to use it. But here's my new layout now that I've grown older and not as quick and, I don't know, agile or whatever you have to be to trade 144 tick chart in the spoos. It's a pretty fast chart, by the way. But this is what I use now. This is a standard kind of go-to intraday chart for me. You can see across the top, we've got the yen, gold, crude, and bonds. Those are set to 377 ticks. If another number that I like for a lot of these, like gold and crude and bonds, is actually 400. It's really hard, though, honestly, to tell the difference in a 377 and a 400. It's really about the same. The reason you default to a 377 over a 400 is it's a fib number. That's about the best reason I've got for you. But basically, take your pick between 377 and maybe 400 ticks. Seems to work pretty well for those. And then when we get down to the equity space down here, you'll notice that across the bottom, we've got the Dow YM on the left, set to 233 ticks. The NASDAQ in the middle at Trader's Choice, 377 or 400. And then the S&Ps I leave set to a default of 700. Now that 700 is not a tick number or a fib number or anything, but it was offered to me as an idea some years ago with a few averages, the moving averages here that I put on this chart, that I found that I agreed with and that I like. So I still use it, I guess, to this day. So let's look at that. All right, so I've got an indicator on here that I want to turn off as to not confuse things. Format analysis. We'll take. I'm going to turn that off. Got an indicator on there that we have it simpler. It's called the Trend Spark, which a lot of us use, but I don't want to confuse things in this discussion. But so I found an indicator some time ago that looked really interesting, and I would call levels throughout the day, like, okay, we're going to buy and sell, here, and folks finally just like beat it out of me. They were like, dude, what in the world are you using? Because this is like crazy accurate, just really good. And I said, well, unfortunately, it's a paid indicator that will cost you a pretty good bit of money to purchase. And so let me just do this. Let me work on it, try to reverse engineer it to where we can, through our own efforts, we can try to use some averages, some moving averages that would largely do like essentially the job of what this indicator was doing. All right. And here's what we came up with. Here's what we found. The dotted line on here that you see is a 90 weighted moving average, 90 WMA, right? So I'm going to write it in the chat. 90 weighted moving average. The yellow solid line, the thin yellow solid line right there, is a 183 exponential. So I'm going to write that in. Listen, this is not an episode of Weird Science. Okay, I told you how I got here. I had an indicator. I'm calling trades all day long. People beat it out of me. They said, look, what are you doing? How are you doing this? Because these numbers are scary good. What is doing this? The answer, you can spend a bunch of money and buy an indicator, or I can go to work and try to figure out a way that I can largely try to accomplish the same within reason and just, and save you the effort and the money, right? And so that's what this is, all right? And then the white is a 314. And I know this sounds like I said, like an episode of Weird Science, but this is what it is. It's a 314 exponential EMA. All right. And then the backstop is a 700. You don't really need the backstop. You get down to the 314s is good. So here's the approach here for this is a trading plan. I mean, this is really like basically just a trading plan. Okay. If the 90 weighted is above the 183, crossed up and above the 183, then retracements into the 90 and 183 are to be bought. Eventually, that will fail. And this is on a 700 tick, okay? Eventually, that will fail. When it fails, finally, the averages are going to cross into a downward kind of skew like this. So you buy this retrace into here, boom, and it works. You buy it, it works, and then boom, finally here, it does not work. Finally here, it doesn't, not, right? The buy into the average right here is going to result in a stop. But look at what the result is. The result is a retrace right back to the 90 and the 183, wherein they cross down, and now you're switching into sell the rallies up into the 90 and 183s, primarily really the 183s, right? Obviously, a smaller dip into the 90s is going to represent a stronger trend with shallow retracements, fewer opportunities on retrace for entry, etc. The slightly deeper retraces into the 183 are more, quote, average, and they're only wrong when you start to see trade the other side of that. But as long as the 90 is crossed down and through the 183, then you're selling the uptick retraces into the 183, and you'll sell that, and you'll continue to do that until finally it doesn't work. And when it doesn't work, it's going to be because now we're crossing back up. The 90 is going to be above the 183, and you're going to get retraces into the 183 that are to be bought until finally one of those retracements does not work. I think on average you get about 3 to 5 retraces that work before finally the thing starts to, kind of fall apart. Same approach on the NASDAQ and the YM. I mean, this is basically just an intraday day trading plan for these products with the tick intervals and the averages and the trade plan. And that is the 90 crossed up and through and above the 183, then buys on retrace back to the 183, etc. Ultimately, once the 90 crosses down and through the 183, then you're selling up tick retraces back into the 183, etc. You do that on these tick intervals. That's 233 on the YM, 377 on the NASDAQ, and 700 on the ES. And I find that that's pretty neat little approach for somebody that doesn't have to know a whole lot about anything, to be honest with you. You know very little. You know that the 90 is above the 183. It's angled up, and I'm waiting for a retrace back into the 183 to buy. And we'll do that 3 to 5 times before it starts to roll over and fail. And when it crosses back down and through, and it's crossed down and angled down, then I'm selling the rips back up into the 183s for range extensions back to the downside. Okay. What's the time? It's only 12:20. We've been at this 20 minutes. We still have a few minutes. Anybody's got any questions? What's the name of the original indicator? Oh boy, that's been a minute. I can't remember. PS Ensign 89, 83, 89 or something like that. It's a crazy name. It's a crazy something or other. I don't know, something. But something, I'm not sure. The question on the board that I'm having a hard time answering is, what was the name of the original indicator that I basically just what I did was started playing with some averages to overlay on top of the indicator until I dialed it in. And there's a lot of, playing around and hit and miss and playing with weighted and exponentials and simples, averages until, you find one that really lays nicely on top of what the original indicator was. And then, you write that down and you got it. Right. I'll be honest with you, I didn't feel like I was doing anything wrong in doing that. I'm taking the time to do the work to find something that largely, as good as possible anyway, emulates something that's out there that's commercially available. And through my effort, if I can get something to essentially kind of do the same job, then I did the work. So I feel like I should, be in the right to share that with you. And that's what I came up with was the 90 weighted 183 and the 314. And they work well. Trendy bands. I don't really know that I agree with what Steve said, because he said there's nothing new, but then everything about it's different. So not sure how to respond to that. If there's nothing new, then why would everything be different? Let's see. Tick charts. Oh, man. And then, there's 1,000 different ways to skin a cat. Okay. Some are going to like these tick bars. That's not the point. The reason we're talking about this is we were asked to cover a very specific topic, which is what I am doing. So the point here is to explain the tick bars, what they are, why one might consider using them, decide if you like them, maybe they work for you. And if so, then I've suggested a trade plan here that you can consider using. It's certainly one that comes with some practice over the years that I feel like I can advocate for and stand behind, because this is my chart that I use now. I showed you the one that I originally used years ago. This probably goes back, this first chart that we were showing. This goes back to probably 2000 and like 6, 7, something like that. Probably 2000 and maybe 7 or something. And you know, and I enjoyed it at the time, but at the time I was, you know, younger and had more energy to chase faster charts around, and I don't feel like doing that anymore, to be honest with you. If that is not you, then you may find that you like these faster charts. Some will, I promise you. Some of you guys are going to like the faster charts. I think over time you get a little, tired of expending that much energy, and you go to higher time frames looking for bigger moves. On average, I find myself using, I'm a 2.5 point stop for a 10 plus point move. ES is kind of average, kind of level of interest for me on an intraday basis. While doing that, though, I'm always maintain. I am flat 0% of the time. There's not 1 minute of any day of 365 days a year that I've been flat for the last, I don't even know, 10, probably 15 some odd years or something. I'm never flat. I've always got a book of positions on. Right now, I'll probably carry 15, 17 some odd positions that range from, Apple and AI and Meta and Microsoft and SPX and volatility and everything in between. But while those trades are working and maturing over time, this is something that we do during, day trade market hours. And that is where my level of interest lies in that time span, is looking essentially for like 10 plus point moves in the SPOOs, that kind of thing. VWAP buys on, VWAP is another great thing, because Michelle's asked a question here that's interesting. It's like, how do you find this works with, looking for trades back into VWAP for like rebound trades and that for off VWAP? I think it would be great. You wouldn't even need these averages. What you would do essentially is, because think about what you're doing. You're going to let price settle down or rally up to, either way, a VWAP, and then start to look to try to identify price turning away from VWAP to indicate that the VWAP has been a good fade, right? So by that measure, you could go to a relatively fast, I would suggest something about like that, probably that 700 tick in the ES. And the answer to your question would be, in my opinion, it's going to be that the tick chart is going to show the turn off of a potential level like VWAP for fade, and do it in a manner that's going to be, on a faster chart, really fast. I mean, i.e., get the idea of the turn quickly, and two, allow you to see inside of what would be, say, a 5-minute candle, and actually get the indication of the initial part of the turn in a tick chart. That's why I like them, and get some indication of the level of interest, i.e., momentum, or I guess we'll go with momentum or velocity of that turn, right? So, in short, to answer Michelle's question, which is how would you suggest this is going to maybe work off of VWAP? I would say good. You're going to see the turn quickly, but in doing so, you don't need the averages that I've given you, because you've got a means of trying to identify a spot for a potential turn. Without my averages, you're going to use VWAP, right? So do away with my averages, use your VWAP, consider going down to a 700 tick in the ES, 377 NASDAQ, or a 233 YM, and So question with a 1 to 4, risk reward on and how long on average you find yourself in time of trade. Well, it does not take long on average to cover 10 points in the ES on average. Right now, we're very much in balance, very, very much tightly wound to balance around 16 in the ES, as I've just discussed. You're not getting much in the way of range right now, nor did we in the overnight last night. Explanation for that I gave you before we started this session, which is, the compression in front of the vol events later this week. But on average is what you ask. And on average, I can tell you this. You're getting right now in this current market environment, which does change slightly over time, but right now, 4 3/4 points of just crest to trough harmonic price rotation in ES. That can happen over, on average, about maybe 2 minutes in time. So if you're getting 4.75 points in average crest to trough on maybe 2-ish minutes, 2.5, some odd 2-ish minutes, then you can see where on average it's not going to take long to cover 10 points, right? There's lots of different ways to answer that question, Coop, honestly. And I know averages because I very much study them, and I show oftentimes in my room sessions the data that I compile and keep in form of spreadsheets, which show ranges, open swing, 15-minute, 30-minute, initial balance 1 hour, ranges, and propensity for range extensions, which I measure for targets, range extensions. So it's going to depend on the day and the level of interest by the trading participants, i.e. marketplace out there, right? But it doesn't take long to cover 10 points. Now, let me show you. I knew to very much anticipate a dull day today of very much choppy nature, and I'll show you exactly why. And this is something that you can do if you want to take the time to kind of get this data. It doesn't take long. As of this morning, before the session started in the overnight last night, the market traded 133,000 contracts in the ES and covered 20 points from top to bottom. It was an 02 by 22 trade in the overnight last night. All right, 20 points wide. I know from keeping this data on everyday basis, I do it every single day. I know that is a small number in volume, and that is a relatively small, not bad, but relatively small number in range in the overnight. That told me that the trading world last night was not terribly interested or awake or participating at any high degree in the overnight last night. If they were, they would have traded 200,000 in contracts, and it would have been 25 to 30 points, probably 27 in range, top to bottom in range. But it wasn't. It was 133 and 20, which tells me, no, we don't care. We're not awake. We're waiting for something. And that something is probably starting tomorrow with Microsoft and Google, and certainly with, as I've got on here, ISM, PMI. You got a Bank of England rate decision. You've got a U.S. Fed FOMC rate decision. You got Eurozone CPI, GDP, and a non-farm payroll report with Apple, Amazon, Google, and Microsoft all this week. And none of that's today. So why in the world would you do any of that today when you know the risk and vol events are still ahead, right? So what you're going to get today is a little lower, a little higher, come back in the middle, and you'll scratch your head at the end of the day today and wonder, why did I even try? Why did I even care? That's what today is all about. And we sum it up in 2 words. And I'll give you a hint. It's not happy birthday. Okay. It's called garbage trade. Garbage trade. Enjoyed it very much. Hopefully this has been helpful. I will look forward to being invited back and sharing with you whatever the next subject might be. For now, if you're joining us on YouTube, know that you're welcome to find us at simplertrading.com. Find your way into the Essentials room, where you can just sit back and enjoy and listen to stuff like this. and the gentleman that was before me, Taylor, others that present throughout the week, give you an idea of some different trading kind of tips and techniques and ways that we do the things that we do. If you're with us in the Essentials room today, thanks for having me. Enjoyed it very much, and we'll look forward to getting the next topic where we will see you again then and soon. Take care.